Just because a bank approves you for a mortgage of $900,000, it doesn't mean that you can comfortably afford the payments. And every year, thousands of buyers discover this after they move in. Because the number that the bank approves you for is often very different from the number your lifestyle can comfortably support. Most home buyers are told what they qualify for, but very few people explain what you can actually afford. So in this video, I'm going to walk you through how lenders actually calculate affordability in Canada, why those numbers can sometimes be misleading, and how to determine the price range that actually makes sense for your life. And later in this video, I'll also show you real examples based on different income levels, so you can see roughly what someone earning $75,000, $100,000, or $125,000 might qualify for. When you're thinking about buying a home, there are two very different affordability numbers you need to understand. The first number is what the bank will approve. This number is determined by things like the federal mortgage rules, the mortgage stress test, debt service ratios, your income, and your credit profile. But the second number, and honestly the more important one, is what your life can actually sustain, because banks qualify you using gross income, but you live your life using net income, and that money that actually hits your bank every month. And that difference is where many people end up feeling the financial pressure after buying a home. So let's start with how the system actually works. In Canada, mortgage affordability is largely determined by federal rules and lending guidelines. The first rule you need to understand is the mortgage stress test. Even if you get a mortgage at a certain interest rate, lenders must check whether you can still afford your payments at a higher rate. Specifically, you must qualify at the higher of the Bank of Canada benchmark rate, which is 5.25%, or your actual rate plus 2%. So if you're offered a 4% mortgage rate, the bank may qualify you at 6%. This rule applies even if you put 20% down, or even if you choose a fixed mortgage, or you have excellent credit. The purpose of this rule is to make sure borrowers could handle higher payments in the future. But it also means the stress test can reduce your borrowing power by roughly 10 to 20% compared to what your real payment would be. And in a moment, I'll show you an example where a small change in your expenses can reduce your affordability almost by $100,000. The next thing lenders look at is something called debt service ratios. These are the limits on how much of your income can go towards housing and debt payments. The first one is called gross debt service, or GDS. In most cases, your housing expenses must stay below the 39% of your gross income. Housing costs include qualifying mortgage payment, property taxes, heating, and half of your condo fees if applicable. Then there's total debt service, or TDS. So this includes all of your debts combined. The typical limit is around 44% of gross income. That includes everything in GDS plus car loans, credit cards, lines of credit, student loans, or other personal debts. And here's where something small can make a difference. For example, a $500 monthly car payment could reduce your mortgage affordability by up to $100,000. Next, let's talk about down payment. Canada has federal minimum down payment rules, and they work like this: 5% on the first $500,000 of a home price, 10% on the portion between $500,000 and $1.5 million, and 20% down is required for home prices above $1.5 million. So if you put less than 20% down, the mortgage must be insured through providers like CMHC, Sagen, or Canada Guarantee. And that insurance protects the lender if the borrower defaults. But it also comes with a premium added to your mortgage upfront, which slightly increases your total loan and your monthly payment. In Canada, putting less than 20% down on a home purchase is not restricted to first-time home buyers. It's available for anyone buying a home as their primary residence. And one thing that many buyers don't realize is that putting less than 20% down can actually have some advantages. First, it can allow you to enter the housing market sooner. Saving a 5 to 10% down payment is often much faster than saving 20%. Second, it requires less cash up front, which allows you to keep some savings for things like closing costs, moving expenses, renovations, furniture, or maintaining an emergency fund. Third, it can also give you more financial flexibility, since the money is not tied up in your down payment and it could potentially be invested in other assets. Finally, because mortgage insurance is required, that insurance protects the lender. So these mortgages sometimes come with slightly lower interest rates compared to insured mortgages. So let's take a look at an example for a $500,000 purchase price. You put 5% down, which is $25,000, and your mortgage amount would be $475,000. You have an insurance premium of $19,950. That is a total of $494,950. So if you put 10%, that's going to be $50,000 down, $450,000 mortgage amount, plus a $14,850 insurance premium, making your total mortgage $464,850. Now, if you put 20% down, that's $100,000, making your mortgage $400,000 And in this case, insurance is not applicable, and your total mortgage would still be $400,000. Another important update that affects affordability is amortization length. Amortization is simply the total time you take to pay off your mortgage. So traditionally in Canada, insured mortgages, meaning mortgages with less than 20% down, were limited to a maximum 25-year amortization. But the government recently introduced new rules to help improve affordability for first-time buyers. So starting in August 1st, 2024, the government allowed 30-year amortization for insured mortgages when first-time buyers purchase newly built homes. Then another expansion took place in December when 30-year amortizations became available to all first-time home buyers and anyone purchasing newly built homes. So this means some buyers with less than 20% down can now choose a 30-year amortization instead of 25 years. This is important because a longer amortization lowers your monthly mortgage payment and can slightly increase borrowing capacity, but it also increases the total interest paid over the life of the mortgage. Now that we understand how the system works, let's look at a few examples of affordability based on salary. These examples assume 4% interest rate, 30-year amortization, no other debt, average property taxes, average strata fees, standard lending rules, and that you're a first-time home buyer. So we'll look at 3 income levels: $75,000, $100,000, and $125,000 per year. And we'll compare the maximum purchase price using minimum down payment versus 20% down payment. If you're making $75,000 a year, your maximum purchase price would be $350,000 with a minimum down payment of $17,500. And in this case, your monthly mortgage payment would be $1,654. Now, let's be honest, that's not going to get you much in Greater Vancouver. So let's move on to the next one. Let's say you make $100,000. Your maximum purchase price in this case would be $500,000, and your minimum down payment required is $25,000. Making your monthly mortgage payment $2,363. Now, that's still on the lower end of what you can get in Greater Vancouver. What if you're making $125,000? Your maximum purchase price would be $650,000 with a minimum down payment of $40,000. And your monthly mortgage payment for that would be about $3,035. So let's take a look at if you were to put 20% down. If you're making $75,000 a year, your maximum purchase price is $450,000. Now that's $90,000 down, making your monthly mortgage payment $1,719. If you were making $100,000, you could go up to a maximum price of $650,000. With a 20% down payment of $130,000, your monthly mortgage payment would be around $2,483. Now, if you're making $125,000 a year, your maximum purchase price would jump to $800,000. 20% down of that is $160,000, making your monthly mortgage payment $3,055. It's not a massive difference, but it does make sense to put more down if you're looking to maximize your purchase price. Now, here's the important thing to notice. Even though the maximum purchase price doesn't change dramatically, the monthly payment and financial pressure can change a lot depending on your down payment. And this is where many buyers who run into trouble because qualifying for a home and comfortably affording it are two different things. And here's where an important difference comes in. Remember, earlier we talked about how lenders use gross income, but in reality, people live off of their net income. So most Canadians take home roughly 68 to 72% of their gross income after taxes and deductions. So if someone earns $100,000 per year, their monthly take home might be somewhere around $5,500 to $6,000. Now imagine a housing payment of $3,000 per month. That might only be about 30% of gross income, but it could easily be 50% of net income. And that's how people sometimes end up feeling house poor, even though they technically qualified for the mortgage. There are also several other factors that can affect how much house you can actually afford: income type, credit score, closing costs, emergency savings, maintenance costs. And something many buyers forget about is the mortgage renewal risks. Most mortgages in Canada renew every 3 to 5 years. That means the rate you get today may not be the rate you renew at later. Rates could be higher, your income situation could change, and your financial priorities may evolve. So affordability should always consider future flexibility, not just today's numbers. It's important to work with a mortgage professional who prioritizes your goals and makes sure that you can comfortably afford the payments long term. A good way to think about affordability is asking yourself a few simple questions. After buying the home, can you still save money monthly, handle higher interest rates, maintain your lifestyle, build an emergency fund? Because the goal isn't to buy the most house a bank will approve. It's to buy the home that fits comfortably within your long-term financial plan. At the end of the day, affordability isn't just a number calculated by a bank. It's a balance between your income, your goals, and your peace of mind. What household income range are you currently in? I'm curious to see where most of yours fall, so please comment below. If you want help understanding what price range actually makes sense for your situation, we're happy to help. I'm Evangeline, mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And here I share practical insights weekly about mortgages, real estate, and smart financial decisions. And if you found this video helpful and want to watch more of my videos, make sure to hit that like and subscribe button. See you soon.